So you can see that this is not a very happy scene. When a credit bubble goes pop, everybody gets really very badly affected. And the irony is that very few people actually know that we're in a credit bubble. It's the sort of thing they discover after the event. But principally, the answer is to get out of credit and get into real money, which is gold. And if you own gold, then okay, gold isn't going to own you anything because the whole idea is you hoard it against this calamity. And don't forget, incidentally, when it's all over, to sell your gold for whatever it is that becomes credit, because you then get back into the game, if you like, of using credit.
17 years have passed since the 2008 financial crisis, the worst economic downturn since the Great Depression. Yet, with economic pressures mounting, some wonder if history sets the stage for a repeat. Total bankruptcy filings surged 13% in January 2025, reaching 41,492 compared to 36,629 in January 2024. Individual bankruptcies also rose by 13%, climbing from 34,503 to 39,134. Meanwhile, the world once again anticipates the long-prophesied collapse of the dollar, only to be met with another geopolitical spectacle, the much-hyped BRICS currency. While its actual impact remains uncertain, economic tensions continue to escalate. Adding to the strain, the Trump administration's newly launched trade war against the U.S., closest and most stable trading partners, could, in time, rival the turmoil of 2008. Renowned precious metals expert Alasdair Macleod has issued a stark warning. The global financial system stands on the edge of collapse, and gold remains investors' only true safe haven. As the head of research at Gold Money and author of the Macleod Finance Substack, he paints a dire picture of an economy dominated by an immense credit bubble inflated by decades of reckless monetary policy. According to Macleod, the only assets truly independent of credit are essential commodities such as food, unencumbered agricultural land, and most importantly, real money, gold. Unlike financial assets, gold carries no counterparty risk, making it the ultimate store of wealth in times of monetary crisis. While it may not generate yield, its primary function is safeguarding purchasing power when the financial system unravels. We're about to explore the video, but first subscribe and hit the bell icon to keep up with our newest uploads. Your feedback in the comments is always appreciated.
The point about credit is that everything depends on credit. I mean, when you buy an equity, you think that you are protecting yourself against inflation, for example. This is a common story because, you know, a bit of inflation actually is probably good for the company's profits. So, you know, you would adjust your portfolio from, say, 60% bonds, 40 equity to 60 equity, 40, well, you know, whatever, all that sort of rubbish, if you like, which the regulators encourage fund managers to work on. The fact of the matter is that when you own an equity, you actually don't own it. It's credit. What you're doing is you're buying the promise from the management of the company or the corporation to deliver to you with your interest an income stream or profits in lieu, which may be retained in the company. But it's worse than that now, because you don't even have that. The major shareholders of these companies are corporations like the DTC, I can't remember, DTCC, you know, the depository trusts. You've got Euroclear in Europe. They actually own the shares, and they issue you, if you like, you're on a register with them as having the interest which is meant to pass through. This is certificateless trading, if you like, you know, which sounds lovely. It's great. We don't have to worry about certificates and transfers and all the rest of it. Fantastic. But the problem is that when things go wrong, the relationship isn't between you and the company. You think you're a shareholder. No. You know, this corporation, which is a middleman between you and the company, that's the shareholder. And it allows them to deploy their total ownership in the company as collateral. It still owes you your interest, yes, but you got no say in this at all. So you've got no protection at all as an equity shareholder. And that bit of distancing also happens in bonds, incidentally. Look at property. Now, this is the other thing. People say property is the best, physical property as opposed to financial property. Well, yes, but in terms of value, you've got a problem in that the purchase of property always depends on credit, and credit in two forms. Firstly, so-called money, which is actually bank deposit. It's a bank obligation to its deposit holders. And secondly, the pricing of residential property depends on the availability of mortgage finance. And when you get, a credit crisis such as the one which I now foresee, that finance isn't going to be available. So we're sort of rapidly whittling down. There is actually, the only things which you can own without credit are things like food, perhaps agricultural land unencumbered, because that will actually produce non-financial things for you. But principally, the answer is to get out of credit and get into real money, which is gold. And if you own gold, then gold isn't going to own you anything, because the whole idea is you hoard it against this calamity. And don't forget, incidentally, when it's all over, to sell your gold for whatever it is that becomes credit, because you then get back into the game, if you like, of using credit, but not before the credit actually collapses. So this is why you've got to understand the difference between money without counterparty risk, which is gold, used to be silver, used to be copper as well, and credit. Credit is not the place to be at the moment, and that covers virtually everything in the financial sector, as principals and also as agents.
Gold is a natural hedge against inflation and is widely regarded as a safe haven asset during economic downturns. While the metal has experienced prolonged periods of stagnation, many investors continue to see it as a valuable component of a long-term portfolio. Recently, gold prices have surpassed their October peak, driven partly by concerns over tariffs, though other factors also shape the market. Further interest rate cuts from the Federal Reserve would likely boost gold prices. However, at the most recent Federal Open Market Committee meeting, rates remained unchanged, with few, if any, cuts expected this year. Beyond monetary policy, gold also safeguards against bear markets and global crises. According to Alasdair Macleod, investors frequently misinterpret gold's true purpose, viewing it primarily as a speculative asset rather than a hedge against currency devaluation. He argues that the key question is not whether gold is too expensive, but rather whether one's currency continues to lose value. He asserts that those who understand this principle will recognize gold not as a speculative investment, but as a means of preserving financial stability. Now let's redirect our attention to a video.
I think it's important to understand, two things. Firstly, you own gold not as an investment. You own gold basically to get out of credit. It's a very, very important point. You're hoarding it, you're in cash, but this is real cash with no counterparty risk. I think that's the important thing. And when it comes to comparing it with something like the S&P, the S&P, the constituents of the S&P actually go out and deploy credit purposefully and productively and profitably. So, you're always going to get use out of credit. You don't get use out of gold. The second point I'd like to make is that the purchasing power of gold is non-volatile. I did a bit of research some time ago. I looked at Diocletian's edict of maximum prices. Now, we're going back to about 302 AD. So this is it's 1,800 years ago, 1,700 years ago. If I can get my maths right. And if you look at the prices of things in those Roman times, apart from the slave markets, which no longer exist, so we can't do that comparison, you look at things like, sort of foodstuffs, eggs, you look at beer, wine has gone down, actually. There's been some fluctuation, but generally, the prices in gold are about the same. And this is interesting. And a colleague of mine, when I was at Gold Money, James Turk, produced a fascinating chart of oil, WTI oil, in both dollars and in gold. In fact, he did it in four major currencies. But the point is that in gold, the price just goes along like that. Oh, I think the most I've seen is about it's risen. The price of oil rose in gold by about 2 times, 2.5 times. The worst was it lost 50% roughly of its value measured in gold. But look at it in dollars, for goodness sake. I mean, it went from I think the 1950 price was something like $2.56 a barrel, up to $140 at one stage. And currently we're looking at 70. I mean, this is the difference. This is the point. You're not really buying gold. What you're doing is you're buying stability by getting out of credit. I think this is the important point. I mean, it's very, very important for anyone who thinks they're investing in gold. No, you're not investing in gold, because when you're investing in something, you look at the price. And, we're all sort of accustomed to look at a price of a share or stock, and, we've seen it rise and we think, are we too late to get in? Perhaps we should wait until it comes back a bit, and it doesn't quite come back and it goes on a bit and you reassess. And no, this is not the case, because it's not gold rising. It's your currency going down. So what you've got to think in terms of is my currency still going down for whatever reason, or has it stabilized? And that should determine whether you have all your eggs in that currency or whether you move into gold.
Gold continues to be viewed as a vital asset for preserving wealth, particularly during economic uncertainty and rising inflation. While some may focus on short-term price movements, the true value of gold lies in its ability to protect against currency devaluation and act as a stable store of value. As economic conditions evolve, gold remains a reliable hedge, offering a sense of security during financial downturns, geopolitical crises, and shifts in monetary policies. Whether for diversification or as a safeguard against financial instability, gold maintains its relevance in long-term investment strategies. Do you believe gold can act as a true financial anchor during periods of monetary instability or geopolitical turmoil? We welcome your insights in the comments section below. If you found this content valuable, don't hesitate to give it a thumbs up, and don't forget to subscribe to stay informed. Thank you for joining us on this journey.